we're effectively trying to rewire 30 to 40 years of globalization, which is going to be very difficult to do quickly. It's going to be very painful. It's going to have lots of ramifications. Our core view is that the impact of this will be, from a macro perspective, stagflation in the US with some consumer price inflation coming through. That tends, through the elasticity effect, to drive inflation and hurt demand. So we think that US demand real GDP will fade towards around zero. We'd expect to see a weaker dollar off that, and also heightened dumping risks into Europe. People haven't thought enough about what Europe's going to do to stop the flood of potential Chinese and Southeast Asian goods dropping into Europe. So we have a lot of shifts. The tariff lessons from history are not good. So we can go back to Trump's first presidency, where we had the US Sino tariff situation. Really, that was a bilateral situation, and now we've got tariffs multilaterally. We can go back to Japan, US in the 80s. We can go back to the Smoot-Hawley Act in 1930. In all instances, when you throw sands into the cogs of world trade, it tends to hurt demand. So what we think we're going to see is a slowdown in global capex after 8 years of capex supercycle. Highly likely now to see global capex and investment decline in 2026. We're going to see demand weaken more in the US and Southeast Asia and other emerging markets. And probably Europe's domestic demand and Chinese domestic demand is more protected than people think. So that raises questions about how you want to position. And we think we want to think about positioning regionally, good companies with strong balance sheets, high pricing power to pass stuff on. And also the thing that's going to matter is the competitive advantage and disadvantage about where you're located. So if you're currently making a compressor in Europe, like Atlas Copco, competing against Ingersoll Rand, making one in North Carolina, you've got a significant competitive disadvantage, which is going to hurt on market share and margin. So there's lots of things to take into account.
So many things to take into account. Fascinating just listening to you lay it out there. Really appreciate the view. I want to pick up first on your comment around the possibility of Chinese dumping, because just a few minutes ago, we got a readout from Ursula von der Leyen's phone call with the Chinese PM Li Qiang discussing setting up a mechanism for tracking possible trade diversion. To my mind, that is speaking to the risk of Chinese products getting dumped in Europe. Just talk to us a little bit more about the possible impact of that and what sort of sectors are most exposed from your world?
Well, so far, we've definitely seen in the world of automotive and cars, in the EV, where China's become a dominant force, and Europe had historically been, particularly Germany, a dominant force in traditional combustion engine cars, that the Chinese have been taking more and more share in Europe. And that's led to the European political sphere wanting to prevent that with a degree of anti-dumping regulations in the automotive industry. I could see a situation in which the European Commission thinks about extending that legislation to a wider gamut of products, because we could now be starting to see further dumping causing ongoing price pressure topics around the European sphere.